You're here on day 3 of Moomoo Investment Outlook for 2024. I'm your host, Olivia Higgins. Welcome back, everyone. It's been a great first 2 days. Now we're on to the third day for our fourth show that we put together, crafted and created just for you for next year, because we're always seeking new opportunities for the new year. So as we round up the last few weeks of 2023, here's what you need to look out for. But before we begin, and while we wait for a few more people to join us, here's a video just for you. Enjoy, guys. Welcome back, everyone. You're with me, your host, Olivia Higgins, and we're here on the third day of our Moomoo Investment Outlook for 2024. But before we begin, please be reminded today is all about learning, okay? I know for the past few days, you've been joining us. You've been giving us a lot of love, energy, and questions. So keep that coming for the last day today, as we have a really exciting topic for you. So do not take anything as recommendations, but use it as an opportunity to network and to also connect with each other, and also be that bridge for us and you to our expert today, and also learn together as a community, okay? And here's the exciting part. You have to listen very carefully to the presentation today. We've got some insights for you from our expert, and you've definitely seen him a lot on our shows. So with that, I would like to introduce the topic of today. And of course, our speaker today is about embracing the storm. So I know a lot of you talk about the uncertain markets at the moment. You don't know what to do, but today we're talking about embracing that uncertainty, but at the same time to look out for potential opportunities within that space. So you've seen him a lot. Let us welcome Darrentay, who is the Head of Treasury Management at Fullerton Fund Management, everyone. Welcome back, Darren.
Hi, good afternoon, everyone, ladies and gentlemen. Thanks for having me. Great to be seeing you guys again, and great to see you again, Olivia. I mean, I'm sure we have a lot more excitement about talking about the markets in 2023, going to 2024, and what's in store for all of us, the Moomoo investors.
Right, Darren. I know this storm topic has been a great metaphor for a long time. And we've done a couple of shows related to this, but it's always about different ways to react to the pending storms, or when the storm is here, right? So this time we're talking about embracing that uncertainty, or even that volatility that exists. Now, what does that mean? But also give us a little bit about yourself.
Okay, basically myself, I run the treasury management at Fullerton Fund Management, and basically I oversees all the short-end liquidity portfolios. I look at some of the treasury products, executions. This is all great stuff, very exciting. It's just like all the investors out there, what you do day in, day out. We look at it from institutional angles. And in terms of this storm, we're going to embrace it. You know, when you say embrace, it's like a hug out there, Care Bears,
Right.
bears. You're gonna embrace a bull too this time. We're gonna see how we look at this in
Mhm.
2023, embrace it with the
Mhm.
interest rate or so, and go into next year. I think that'd be really exciting for all of us to think through.
Absolutely. I agree with that. I think a lot of the audience members, you can keep your questions for the end, but type away anyway, because we will use the second half of the live show to answer the questions for Darren today. Now, Darren, you talked about the objective of today, the topic, but, I do want to just open up just for our audience members, the current global context at the moment, before we go into our fireside chat. Now, is there anything you want to outline on the potential spaces that we could look at going into next year?
I think into next year, it's all about all the different storms potentially again, how it's unfolding into year end and into next year. I guess the biggest question for all of us is like, what's going to happen to interest rate? It's going to stay high, go higher, or go down. I have some interesting thoughts for everyone later on. I think that's a very key point. Maybe last but not least, how the cash liquidity products are doing well out there into 2023. How do you use it in 2024? And perhaps a bit of chat about the liquidity fund also, the T0 liquidity fund, the long-awaited one. I'm sure we have a lot more conversation on that down the road in a moment.
Yes, absolutely. I'm really excited to hear all these new announcements. I mean, there's so many new things to upgrade for 2024. So I'll show that as
Mm,
well to our guests tuning in.
okay.
Again, we got more people coming in. Welcome. You're here on Moomoo Investment Outlook for 2024. Very happy to have you here. We're here with Darren Tay, who is the head of Treasury Management. Now, everyone, type in, put in your likes, put in your hearts down in the comments below if you are ready for today's discussion. Okay, so with that, since we kickstarted off with the potential, like macro issues that they could look at. So let's really look at the
Mm.
assessment right now of the tensions ongoing on a macro global scale.
I guess in terms of the assessment on the macro scale, there are really a lot of geopolitical risks that's going through, something we'll chat a bit later on. For example, we all talk about the Russian-Ukraine situation.
Mhm.
Next, we have now the Middle Eastern situation. And guess what happens if we have a North Korean situation coming through? Well, we're going to have a lot of things to sort of
Right.
reckon with. There's enough of things out there that we need to think through and how the central bankers, how the government policy is going to pan out. These are areas that we need to spend a lot of time to have rigor assessments, research on it to get a best rate out there into the market.
That's right. So currently, since our last webinar together, I
Mm.
mean, we've had many lives this year, but since the last one we had, how would you say that progression unfolded going into now?
That time we're saying that we are so-called running into the so-called eye of the storm, if you recall, and I'll share that slide in a moment.
Mhm.
Uh, we're talking about eye of the storm, calm, but trying to embrace everything. This time around, we're trying to get out of the storm with a little bit of sunlight, a bit of sun ray out there. That'll be very exciting to say, look, maybe looking at 2024, it could be a
Mhm.
better year. It could be a rough one, but quite a few things for us to ponder so as we go along.
Absolutely. So
Mm,
with that, Darren, let's go really into the details of the
mm,
assessment of the potential risks around us, right? So let's start off with the geopolitical risks, and
mm.
also the financial storms for perhaps the first half of 2024. What is the assessment of that from Fullerton's perspective?
When we look at all these financial storms, geopolitical risks, that's what I call there's always opportunity for all of us. And we have to seize the opportunities, size it all the time, and get it right. So if you look at all the storm that's happening through, as what we're seeing in some of the last couple of months, you probably see situation like, the Middle Eastern situation, the
Mhm.
banking turmoil, the US debt crisis, the China issues in August. All these things presents opportunity for all of us. But it also means that on a tactical basis, you may make money, but on a longer term basis, you need to also position well. We could also well be in a situation whereby we all go into 2024 with a Goldilocks. And what I mean by this is that interest rate can continue to be
Mm.
high, and maybe at a stage whereby all of us continue to see the markets doing well. And that's what you're seeing in the last couple of weeks. I mean, market has gone through a ballistic run in US markets, and hopefully Asia will come also. And these are really opportunities for us to capture from here.
Mhm. Are there any particular sharings or insights you would like to share with the audience today with this topic?
In terms of the topics, I'll probably highlight some of those things which I mentioned. In fact, we can also talk a little bit about the Ukraine-Russia situation. It has
Absolutely. Let's start
also
with
gone.
that.
Sure.
Yes.
Yeah. Should I just go on with that? Yeah. Maybe we'll just have a bit of chat about what's happening to the
Mm,
Russian and Ukraine situation.
mm,
In the
mm,
whole scheme of things, it is getting a little bit more long drawn, I would say.
mm,
That started in February 2022 last year. It's almost like 22 months now. And I guess with that as a mindset, I think people are getting a bit tired thinking of
mm,
what to do. In the European nations, you can see that they're trying to also increase their foreign power via NATO. NATO, for example, Finland has just joined them in April this year. They're now their so-called 31st countries, all right?
mm.
And what I think we should look at is that even if you look at NATO, for example, 31st country is one. You're trying to
Mhm,
join, even the next one would be Sweden. Sweden
mhm,
is also another country that sort of came along, but they're having some issues with Hungary and also with Turkey on all this situation. And going into the further details, I think what I would say is that on the Russian side, I think they're having a good time. And why I'm saying they're having a good time is because if you look at some of the so-called budget, is coming to the maximum. And why I say it's the maximum is because they have gone to what they call a record budget in terms of defense. They're building all their corporates to the next level. Their unemployment is really getting very low. They're hiring like almost 20,000 soldiers a year. I think that's fantastic. They're all ready for the next battle. And all the sanctions are not exactly working somehow in that perspective, from a global perspective. And also, we should be mindful about some of the situation whereby if there's going to be any of those drone attacks or attacks on the oil and gas in Europe, that could be another problem to come. So that's something for us to think through. That means that Russia is probably at a so-called upper hand in today's context, while the European nations and the world is just feeling a little bit pressure on what to do in this Ukraine and Russian situation. Maybe still on this slide, let me just share and kickstart by highlighting embracing the 2023 financial storm. What it really means. We talk about the word embracing.
mhm,
And when we talk about the word embracing, what it really means is that this year we're going to be sort of like hugging it. We know what's happening already. We're moving to next year, 2024, and hopefully we can understand the dynamics well and continue to do well with the whole macro environment. If I can just highlight the 4 items here on the screen for everyone. If you look at point A, it's about US banking turmoil. Why I say that is because if you look at in March, you have the
mm,
Silvergate capital problem, the Signature Bank, and the SVB financials. All this were creating financial stress, banking turmoil in March. You look at point B, you have the US debt ceiling, which started in the 2nd of May. And guess what? Treasury Secretary Yellen said that, guys, everyone out there, we're going to risk exhausting all our cash in our bank account. And therefore, you can see the Treasury bill of the 1 month of spiking 100 basis point. And that's definitely a concern for the entire economy. China debt problem in August, that was also happening, and it unfolded with the CSI 300 registering some of the toughest moment in August. It was down by 6.2%. What happened because the so-called LGFV, which is the local government financing vehicles, they're getting some pressure out there, new loan pressure, Country Garden, Evergrande, all these corporates are feeling the heat. So the market sort of trend lower. And of course, we have the Israel and Hamas situation that came along. And all the situation created different level of tension, concern, and diplomatic ties between the Middle Eastern nations and the Western powers. All in, this happened in 2023. And if I can just share and point to the bottom of the whole slide, as you can see, what it really means is just have a look at the arrows, the blue arrows on the way up and the red arrows on the way down. And before I go to all those blue and the red arrows, what I want to share on all those different lines on the chart is basically your S&P 500, your stock 50, the Asia equities, the ETFs of IG and the high yield bond. But what I really want to share is that the arrows at the bottom of the entire slide is telling us that it goes up, go down, up, down, up, down. And it's so difficult because it was such a volatile market to be trading, to be investing. All these risks we notice, we are alluded to. But guess what? In the last couple of weeks, we had a massive rally, US market especially. By the way, US is up about 20% year to date. It's a fantastic run. For those who are investing in the US market, I think that's great news for you. I think all what I'm trying to share is that very volatile markets, and then something that we should really think a lot more about how we are planning this situation into 2024.
Mm-hmm. Thanks,
Yeah.
Darren, for that. I think we're already getting questions related to the geopolitical risks. It's
Oh,
a very popular hot topic at the moment. We're not just talking about Ukraine and Russia here, but of course, we started off with that, with our live shows, analyzing the key parts of the storm, rising and also being in the storm, right? And now trying to embrace that because we do know, like you mentioned, it's long drawn at the moment. So we'll see how it goes next year in the midst of other geopolitical risks that have also come up. So the next question then, which key countries are having the elections in 2024? I mean, I don't really have to say, right? It's pretty obvious. And what sort of timeline and market capitalization impacts can we foresee for next year?
yeah, I think election year is going to be a very exciting one in
Mm-hmm.
2024, and
Mm-hmm.
many nations out there are going through an election year. But maybe what I should just share with everyone and to start, and maybe let's look at point number three, point C. What I thought is very interesting to share on point C and then tackling the part of election in a moment is that if you look from a tactical front, and given some of these things that I mentioned earlier on about having some of these so-called storms that we're trying to embrace and trying to sort of like write that into 2024, there are a lot of opportunities for all of us as traders, as investors. And I like to put this forward to everyone. I think the first point we notice at the bottom of it, be opportunistic in our positioning. And why I say that? I think if you look at 2023, I thought it's going to be a bit more hilarious, funny, and yet a serious observation for all of us to think through is, if you look at 2023, we are in fact a bull in a bear suit. Can you visualize me wearing a bear suit and running like a bull out there? Why we say that? Well, that's because you look at S&P 500 up 20% this year, okay? And rates are so elevated as you can see on the screen. Do we really have any crisis? The answer is no. In fact, the answer is that we're having a very massive bull run in S&P 500, up 20%. If you buy the Magnificent Seven or your Meta, your Google, I'm sure you're going to get more than 20% in terms of a run this year. So I think what I'm trying to share with everyone is that in terms of your tactical front and trading, last year, or rather this year, I should correct myself, 2023, we are a bull in a bear suit. And we should always think in such a way whereby we should have a contrasting positioning flows. Look at what the people is just getting a bit too crowded. Avoid going to a crowded trade. I think it gets really a little bit uncomfortable. That's what I think. Second point, if I may just go through that, we should be mindful of the markets and expectation on inflation and interest rate. Why is that? It's because if you look at the right-hand screen, I mean on the right-hand side of the screen again, these are the G10 currencies. G10
Mm-hmm.
currencies
Mm-hmm.
exclude China. Every nation, every key nation is having a massive run of this interest rate hike cycle in 2022 into 2023. Very, very aggressive. And why I say that is because the inflation and all these so-called financial challenges are a big headaches to the central bankers. Therefore, they continue to hike all the way up. And if I can just bring it up back to the point on the left-hand side at the bottom, and why I
Mm-hmm.
say mindful about the market expectation and inflation rate and interest rates, because remember, well, the Fed Chairman Powell, he said, well, in May, maybe he's giving a hint that, oh, we should start pausing interest rate hike. But guess what? It went a bit higher. It shocked everybody. It surprised everyone. So what I'm trying to share is that whatever you see on the screen, on the market, on what people are thinking, form your own opinions, form your own views out there. It's very likely some of this crowded trades is going to be wrong from what I can see in some of the expectation. And maybe to highlight on what Olivia asked me about election year,
Mm-hmm.
2024, it is a super election year globally.
Right.
Why I mentioned that, maybe I'll just give a bit of narrative what I mean by that. In every election year, in any countries, chances are market tend to have a good run, a positive drift on the equity market, a positive drift on the risk asset. I'll give you a very simple example. In India, in the last 40 years, 6 months to run up to the election, guess what? The Bombay Stock Exchange would have rallied about on average 15%, 15% every time into the run-up of the election in the last 40 years. So what I'm trying to share is that when we have an election year, there is a likelihood, that the market, the risk asset can do a little bit better from here. I think that's how it's going to evolve. And also, what are countries out there that's having an election year next year in 2024? Let me just visualize the Google map. Maybe at the start, from one side to the other side, you have US facing election next year. You have Mexico. You have probably the EU nation, the parliamentary election, Russia, South Africa, India, Korea, Taiwan, Indonesia. And guess what? All these countries add up, okay? In total, they are about 80 to 85% of the total market capitalization. So if all this market really run in synchronization because of the election year, I think you're going to see a very sentiments-driven kind of rally, something for us to think through, and that's very important. And maybe one last point to share is that where the timelines of the election, well, I would say most of them would probably be in the first half of 2024, starting with Taiwan, in mid-January, it's going to start. Most of them will end probably by June. Maybe South Africa, July, August is not really confirmed yet. And maybe the last one will be US in November. So these are all the so-called markets to watch out for, and it may potentially have a bit of a sentiments rally that's coming through for the entire ecosystem.
Mm-hmm. I think we mentioned that it's really important, that it's not, I said it was an obvious answer with the election because everyone's got the US in their minds. But of course, you got that amplified effect with all the other countries. So really important points brought up there for our audience. And of course, Darren, we have a lot of questions coming in for you already.
Really?
But
Okay.
we'll save
Okay,
those
good.
questions for the second half. Okay, very popular. Darren's very popular here. So keep them coming. Anything you want to ask
Thank
him
you.
right now in terms of insights, and keep them coming, okay? Because I'm actually tracking and I'm about to pick the top questions to ask for the second half. Now, you talked about, okay, the different market capitalization impacts as well, but let's really zoom down to the rate situation in the US and Europe. What can we look forward to for next year, and what is the outlook for that?
Okay. I think I do have a slide out there. Maybe we can just scroll down a little bit, if I may. Yeah, no, thanks for this. I think in terms of the rate situation in US and Europe, there's always a lot of debate, a lot of rigor discussion. Is it peaking? Are we always data dependent all the time? Or is it high for longer? I think it drives in a lot of different narratives. And maybe let's start with the left-hand side on the screen, the US Federal Reserve. I think they have started hiking since 16th of March 2022. So they have hiked a total of 525 basis points now. That is an enormous hike. And why I say that? By end November, which is now 2023, the rate hike is into its 21st month, all right? And the velocity of this rate hike is at a fast pace of 25 basis points per month. Can you visualize? Every month it crossed January, February, March, and just keep going. Every month it's at like 25 basis point hike out there. I thought that is really, really enormous. And I think the key sharing on this is that I think the market thinks that the Fed is really peaking because the market thinks that currently we're running around 536. That's the peak probably in Jan 2024 based on some of the data points from Bloomberg. Currently, our low bounds at 5.25. It's almost there. I think that's the belief of the market situation. And I think the other thing to also share is that on the right-hand side, how about the European central banks? Well, started in July 2022, a little bit slower than the US market. We get it. I think they have different dynamics and environment. Has hiked 450 basis point. Not too bad. It's also very decent out there. A 450 basis point hike. And by this month, end of this month, the rate hike cycle is into its 17th month. It's also at a very fast pace because the velocity of a rate hike is at a fast pace of about 26 basis point per month. So what it means is that, again, every month we are hiking like 25, 26 basis point is really very, very strong. So I think what the market thinks is that it's also peaking. And at the same time, when it says peaking, some of the market participants are thinking that we're almost there already. Therefore, this is where the level is going to land. I think that's probably the narrative. But I think what is more important is that those are the data points in 2023 and also in 2022. Let's have a bit of talk about what's going to happen into 2024, even at the start of the year next year, which goes down to probably the bottom of the slide here. So I guess all of us has to be a bit more vigilant of the so-called narrative out there in the US and the ECB's view. And why I say that is because if you look at some of the conversation as you read from the website, the apps, the papers and everything, the views are increasingly very much contingent on the new available economic data. And what I mean, especially in US. So if you hear some of the conversation out there, even just yesterday, quite a few Fed committee members came out and say, okay, I think some of this thing is working. It's definitely working quite well. They have tamed some of this problem of the inflationary problem. And this was probably just hot from the ovens 24 hours ago or 12 hours ago. What some of the Fed committees said yesterday was that, okay, I think we have tamed some of this price pressure that's from a so-called supply disruption problem because due to all the supply disruption, the prices has been sort of like accelerating and doing so fast, going so fast. Now, we have this interest rate hike that's so aggressive. We want to make sure that it's getting transmitted into the economy, into the financial system, into the real economy. So what they're trying to share now in some of the conversation in the last 1 month or so, and also in yesterday's sharing with some of the Fed members, they felt that now we are very much data dependent. I think that's a very key point. And many of them, both central bankers, whether it's the US or Europe, they all shared the very key fact that it's going to be high for a bit longer. They do not think the cut is going to come so soon, especially ECB. In fact, Bank of England just said that yesterday again. It's going to be not so soon. I think that's what the central banks are trying to share with everybody. We want the data points to be very much contained. We want inflation to be very much contained. And then they'll say, okay, I think we can have a bit of easings of the market. So the expectation for most central bankers globally is going to be probably in the second half, if not even a later part of the second half to come. And I think there's also one very interesting point for us to think in 2024 and also at the start of next year, is that apart from how the view of all the central banks are going through, you notice one very interesting trend about all of them. So what's the interesting trend? They all said that there's this shifting of attention from the so-called short-term to the longer-term debt. So you see, the more they try to hide on the short end, the more pressure they're facing on a lot of different dynamics and conditions. But now they're a bit more focused on what's going to happen to the long-term debt. If they keep hiking, what we're going to see is that the mortgage rate is going to go really high. And you can see in US, the mortgage is really going very high. Look at the interest debt payment. Gosh, that's going to be a huge payment out there. Just to give you some data points, US in terms of the debt is about 33 trillion in total. The Federal Reserve probably now runs about 8 trillion in debt. ECB about 7 trillion USD. Japan about 5-6 trillion. Big numbers. The more you want to have high interest rate, you're going to get a high interest payment coupon on your debt. I think they need to think twice in trying to go a bit higher. And the last thing that's very important for us to think through on their mindset is about the unwinding. There's this key word about unwinding because they have so much debt out there in US, in Europe, in Japan. You know, central bankers are buying up so much debt out there from the market to create this easing environment in the last 24, 48 months. When they unwind, they're basically trying to sell down the debt that will put pressure on the yield to be higher. So they are very focused on not just the short-term rates now. Now they're trying to visualize how would it impact the long-term rate and also the corporate earnings. I think this will come down the road for us to think through in 2024. So I hope that shares some thoughts. Sorry, I'm just getting a bit more excited and my adrenaline is picking up. But I really love to share all this things with everyone. Over
We
to you,
love
Olivia.
that, Darren. I mean, always having you on the show and have you share your expertise and insights here, really, really valued by the community right here. Now, if you want to see more of this, type in a yes in the chat box. I think that's my favorite word now for everyone. And also give us a thumbs up wherever you're tuning in from. And also, of course, I love the hearts. So if you're liking this particular live right now, because it's such an important topic of embracing the storm, type it in right now, okay, as we continue learning the potential opportunities for next year. Now, we covered in depth the situation situation, the rising rates environment that we always talk about in US and Europe. But, let's go back to home, going back to the Asia Pacific region. Now, in our previous lives, Darren, we covered China, Japan, Singapore. What is the update on that in terms of the rate situation?
Okay. Yeah, maybe I'll just share some thoughts on that. I think there's also a slide on this. In terms of the rate situation, if you look at the whole Asia Pac region, I think we are in very so-called bipolar kind of dynamics. Let's start with China, the big brother in Asia, the key economy out there. It drives the entire Asian market very, very, well, and it's very important. Let's look at the top left-hand side. China is in its easing mood. They have been cutting a lot of rates out there since September, all right? And you look at PBOC, they have lowered all the benchmark rate, whether is it the triple R, the reserve ratio, 7 days repo, MTLF, the midterm lending facility, loan prime rate, whether is it a so-called easing between the central banks and the so-called commercial banks out there, or the easing of the commercial banks and the so-called retail, the mortgage loans, homeowners. There's lots of easing. I think this monetary policy easing has been going on for the last 2 years. Is extremely, extremely aggressive. And for that reason, there was some pressure on even the CNY. But guess what? I think what's happening in the last couple of weeks, the dollar CNY has in fact came all the way down. That means the CNY has been strengthening. It's giving some symptoms, some so-called brief of life that the market potentially is stabilizing. There's a lot more interesting that's going through. For example, President Xi Jinping went to US, shook hands with the business leader, great rapport with President Biden. These are all clear signals. It's not anything that's written on papers, but you can see that it says we're going to have great partnership, going to do well together. Let's win together on the economy. We're going to make it happen and recover from here. So China is a country to watch in terms of economy, its financial market. I think it's something that it will have to really turn around. But I do acknowledge in today's context, it is facing a lot of very weak data that people are very careful, and I understand that's the situation. Japan, on the right-hand side of the screen. Japan, what happened is that we're in what we call a new deliberation mode. That means we think that's easing, but, well, not exactly easing. Why is it? That's because if you look at the CPI in Japan, it's above 2% for, I think it was just 1 week ago, above 2% for about 18 or 19 months already. It's really kind of a silent denial kind of environment. Why is that? It's because the belief is that Japan should always still be in easing, but the inflationary pressure is just definitely coming up. So CPI, national CPI is above 2% for about 18, 19 months. And if you look at the BOJ governor, Yoida, well, he came in July, thereabout, and he looks very focused, very, very much intense on what you call this thing, YCC, which is the yield curve control. What it basically means when you say YCC is that Japan as an economy, as much as they target the low end interest rate, the short end, sorry, that's what I mean, and also the longer end curve. Longer end curve, I mean, say, for example, the 10-year JGB. So that's what they call the yield curve control. So the aim to ensure the easing mode is for Japan, the BOJ, what they'll do is they'll basically have to really sort of buy up the JGB. When they buy up, what it means is the yield will go down. But as they continue to do this, the yield continue to keep going up. And it's now heading about 0.7, 0.8. They will never tolerate above 1% yield on the JGB. So is that something for us to look out for? So all in, what I'm trying to share about Japan is that it is under a transformation. Inflation continues to be firming up and the yield continue going higher. Singapore is probably another one to look out for. And when we look at Singapore, it's always an early adopter in terms of the government and the policies. And why I say that is because they started even tightening in terms of the so-called monetary policy in October 21. And that is very early, if you recall. For the Federal Reserve, it was March 2022 last year. ECB for the EU market, that's July 2022. Singapore is October 2021. So it's much earlier. And they have been on a tightening bias 5 times between October 2021 to October 2022. They have done it 5 times. They're trying to let it ease and translate into the so-called financial market. In April this year, October this year, the MAS policy statement said, okay, we understand, we have tightened a bit. What we're going to do is that it's currently sufficiently tight. We're not going to alter anything out there. We want to see how the international trades are moving, how the FX regimes are going through. And guess what? If you look at the bottom right-hand side, the FX regime is showing that the Sing dollar is still very strong. We're still in a very sufficiently tight kind of regime. And if you look at the last couple of weeks, the data point has been very, very, positive. Why I say that? GDP for quarter on quarter, it was very strong. It's up at 1.4%. The market survey from all economists is at 1.1%. So it's getting better in terms of Q on Q, in terms of GDP. Q2, it was also healthy. It went positive. The initial survey by all the economists was negative. And of course, in a Q1, in terms of GDP, it was in a contraction. We thought some of this technical recession is coming true, but no, it did not happen. And the MTI, which is the Ministry of Trade and Industries out there, they have revised higher the GDP for full year 2023 and also 2024. I think in terms of all these dynamics, is giving us a signaling expectation that the data points are still pretty firm, pretty well entrenched, and this is narrative of the market and condition, both in Asia and in Singapore. Hope that shares some thoughts around that. Olivia.
Thank you for that. Very comprehensive. And we have more people asking related to the Asia Pacific topic. So keep that coming, everyone. Now, the next question then for Singapore. What's your take on the Singapore inflation rates, given it has an impact on Singapore FX policy and your fund's yield?
Okay. Maybe I'll share a bit about where the fund yield, the assets and everything. I think there's one slide on this. If I can just share some information on this slide. There are some very interesting information and some transformation that we should all take note of. In terms of the data point, in terms of, say, the yield, the gross yield is running about 4.05 for the SGD cash fund. It is a very, very decent number. What it means is that the whole portfolio on a day-to-day basis, you're getting 4.05%, which is a very healthy yield compared to savings deposit. It's running at a very short weighted average maturity of 41 days, 45 days. In fixed income world, we call it duration. In the liquidity and the cash world, which we are expert in, we call it WAM, weighted average maturity. Thank you everyone for this. And I should say that the AUM of the fund is now running about 4.2 billion, as you can see on the bottom left-hand side. It is a very decent AUM in terms of its assets out here that's being managed. And I think adding on to all this information, I would like to share the investment profile, how things are evolving currently in 2023 and into 2024. I think it's a very interesting observation I'd like to share. In terms of the clients who are looking at this fund and people who are having engaging conversations in the likes of it, I noticed that we have like long-term investors, insurers who love this fund. They're non-profit organizations, academic institutions, distributors, solid platforms like all the places out there. Like today, I think we're having some of these great conversations. Retails, private banks, a lot of people are looking at this fund and they love it. I think they enjoy it. There's also a emergence of a new group of clients that's coming through. For example, they love daily auto sweeping, digital wallet, regional clients because of some FX so-called risk. They want to put their money from like maybe US or any other currencies and they like to put in Sing dollar. We're seeing that kind of regional clients evolving. And I think it's very important to say note in today's context that cash has a real yield. It is a very attractive asset class, a very good allocation. And there's also some paradigm shift that is going through. And maybe before I go into the keyword about the paradigm shift, I'd like to highlight two very keywords on this screen as in bold, somewhere in the middle. The keyword industry problem or weather fund. I'd like to really emphasize a bit on these two keywords. When I look at this fund, it's not just about having a commercialization or having a successful product. When I look at this fund and I try to run it very successfully with all my teammates, with all their sweats and tears every day, we chatted, we laugh, we have pressure every day at work. Thank you, teammate. I know you're out there listening. I'm sure somehow one or another, and a lot of colleagues around. We want to solve industry problem. What we mean by this is that when we look at some of our savings deposit, it is really maybe a little bit on the lower side, maybe 5 basis point, 10 basis point. How can I make a difference? I like to solve something for the market. And when you think of this, you're very excited, you're very much driven with a lot more adrenaline to want to do it better, to have done it for the last, more than a decade, 15 years, and more funds being so-called transmitted and shown to the market. It shows that we really want to make something happen. And I think the other point to share, if I can just go back to just now that slide, please. Apart from saying it's an industry problem, it is an all-weather fund. There's a very important point when we say and use the keyword all-weather fund. If I can just have the slide earlier on, please. If not, I'll just chat through. What I mean by all-weather fund, thank you. When we have all those all-weather fund, if you look at the bottom right-hand side, this is a very interesting slide for all of us. Why I say that is because if you look at the slide, what it means is that there are two boxes. On the right-hand side, there's this so-called screenshot diagram. There's two boxes out there. There's a left and a right box. The left box, if you notice, the so-called lighter color ones, which is your yellow and the pink color so-called lines, it went downwards. That's where the interest rates are getting cut massively. And the beauty is when interest rates are on the way down, the blue and the white lines, which are the AUM of money market globally and the AUM of the Singapore so-called Fullerton HG cash fund, they're on the way up. All right, so it's so-called going on opposite direction. And I'll share the summary in a moment. On the right-hand side, there's also another box. When interest rates are going higher, the money market funds globally and the AUM of some of this cash fund, liquidity fund, continue to go higher. This is a very interesting learning for all of us and why I use the keyword paradigm shift out here. When rates are low, people, investors would like to buy into this fund. When rates are high, investors also love to buy into this fund because they know that it's solving the efficiency issues. They are going to be like getting very close to your ecosystem, WhatsApp. They can do all these things. They get a healthy yield. They can look at all the cash flows together. And it has a lot more benefits around it. And I'll talk a bit about the T0 in a moment. I think there'll also be something exciting for the year to crowd down here. So what I'm trying to share is rates go down, rates go up. I think there's always a need for all this liquidity and cash fund. And I think there's a very important transformation that's going through. And that's the new digital wallet potentially is going through for a lot of people to consider and take note of. Yeah.
Thank you, Darren, for that. And that was covering also just the Singapore side of things and inflation rates and also the fund's yield, okay, and how that impacts that. If you missed out anything, because I see a lot of new people joining us, you can always watch the replay in-app or on YouTube, okay? And Darren, we're getting a lot of thumbs up for you in the chat box.
Thank you.
Yes, so thank you for being with us on the show. Keep those questions coming. Next question, could you share some key features and trading benefits on this T0 Fullerton SGD liquidity fund you mentioned before? Now let's go more in depth before we round up our fireside chat and go into the quiz one.
Okay. Yeah. The T0 Fullerton, liquidity fund. I thought there's something very interesting, very important. There's a slide on this. If I can just share a bit of thoughts before I go into that point, if I can just have everyone focus on point number 4. We are the so-called team, myself, again, I'm not alone, my great team, partners out there, colleagues, we run this for very long already. We are specialists, we have specialization in cash fund, liquidity funds. We do it across a wide spectrum. We manage a very tight settlement cycle. We also want to have this kind of dialogue. We talk to you, understand your pain points. We talk to a lot of people on the street. We want to chat and see what people are missing out, what's their problem. We try to think of a way to solve. We transform some of this electronification. For example, if you ask me, say 5-10 years ago, how do we place a fixed deposit? Maybe we need to sort of call someone on the phone, send an email. Today it's all electronified. We positively influence the market to be leaders, to do it faster, efficiently, and to be price discovery players out here in the market. We continue to digitize. We kind of think of new ways to transform the market. The T0 liquidity fund, as what Olivia has mentioned, is definitely one of the so-called transformation that's coming through. It is an exclusive collaboration between Moomoo and Fullerton Fund Management. I know it's also an upgrade and innovation, but a cash plus. I heard about it. The smart safe, I think, is coming through some of this transformation. I thought those are great ideas. I was being briefed, I was being told. I thought that was really something that's transforming very fast. And with that, as a collaboration, I think we should ask ourselves, so what are the key features of this liquidity fund? Well, it has what I call a same-day settlement cycle. That's why it's called T0. It's also allowing you to have a vision that there's an alternative to some of your saving deposit that you may have, or what I call a digital wallet. So you can see the whole electronification, the AI, all of us are transforming. If you ask me like 20 years ago, maybe our handphone is like super big and then, cool. And then the phone gets smaller and smaller, it transforms. And now maybe we don't even carry a phone, we just sort of tap into our earpiece or whatever. But I think the transformation drives all of us to be innovating. So what I'm trying to share is that it potentially can be an alternative to digital wallet, savings deposit account. It will also give you a yield that's also comparable or competitive to some of this saving deposits rate. So what I'm trying to share is that it does have the same day settlement. It does have a good alternative to some of the savings deposit account that you may have. It can be also competitive to some of the same rates that you're getting. So these are all the nice and great features out there in terms of what it really means for this T0 liquidity fund. And the last thing for the investors out there, I'm just very keen to share. What does it mean on a trading? Of course, we can say, yeah, these are the features, but how can it be of use to all of us? T0 liquidity fund. I can straight away think of two very important so-called rationale why we need it from a trading perspective. I think the first thing is about better flexibility. So what do we mean by better flexibility? So let's, for example, you want to buy into a US stock and you need to do some funding. And what you potentially can do is going to be so easy because you're not going to buy tonight, for example, at US market. You have this T0 fund. You can straight away redeem it and you can straight away, do your transaction and pay your so-called US stocks in a very quick way. So that turnaround, better flexibility in resizing, repositioning, I thought that's great. So a classic example is like, if we have a banking turmoil again, you have a Middle Eastern so-called turmoil, and if the risk assets sort of fell, wow, what you can do is maybe you just redeem some of your liquidity fund and then put it into the so-called US stock market, if the belief is that you think there's an opportunistic buying. So what I call is the better flexibility is a very important point for the Moomoo traders out there, the Moomoo's traders. Second point, on the trading angle, and also very important, if you hold on to your T0 liquidity fund, okay, what it really means is that you don't have to do FX in advance. So let's have a visualization, again, the US stocks. And that's really happening now. The US is definitely very much weaker in the last 2-3 weeks. Sing dollar is very strong. If you have one of this transaction again that you need to buy into US stock, you don't have to really even have a US dollar in advance. You don't have to buy an FX in advance. You only do the FX when you have this Sing dollar T0 liquidity fund, redeem it, convert FX, buy into the stock. So there's no FX risk for the last few weeks. And I understand there's a beauty. You don't have that margin cost that you need to go and bear if you ever have all this conversion situation to think through. So these are some of the interesting things that we need to think through from a T0 liquidity fund, which I thought would be quite useful. So I hope that gives some thoughts about what it really means. And I'm really getting excited about this T0 liquidity fund. And we're going to grow a lot more into this space in innovations and make it useful for the investors. Over to you.
Absolutely, Darren. Us too. I mean, thank you for highlighting the details of that, but we'll definitely clarify some of the questions we have related to that, okay, for the T0. Now, let's round up our fireside question because I want to give the giveaway, the surprise quiz one for our audience members to reward them for being here with us. Now, in past forums, you shared the price actions of a commodity, right? So, we talked about keropok, chicken, soybean, I mean, chicken rice. What is your sharing with the audience today related to this particular topic?
Before I start, I think next time, Olivia and the movement, I think maybe call me Mr. Foodie next time. I guess why I like to talk about all this is because price effect, price impact is out there in the global financial system. It affects all of us on our daily lives. So you're right, we talk about keropok, in Indonesia. We talk about the chicken out there in terms of the neighboring countries, and of course also some of this so-called data and information in terms of the soybean in Argentina. I guess today I'm going to talk a little bit about sharing a bit about rice. Why I say that is because if you look at the benchmark Thai rice index, it has, in fact, at the start of the year, it was at about 430 US dollar per metric ton in terms of the rice. And if you look at today, it's probably running at about 610, 615 US dollar per metric ton. In essence, year to date, it's about 30%. And allow me to use this word. I saw, and somebody was reminding me and sharing about me in some of the web chats where we eat my Thai fun, the Thai pum. I don't know, Olivia, if you know what's Thai pum. Thai pum means the rice with, oh, you know, okay. Thai pum. I eat that sometimes and I quite enjoy it. It's really comforting
Your
food.
favorite.
So, yeah, one of my favorite. I try you eat once a week perhaps. So the chai pum with some of this veg. So the rice is going to go up, by the way, guys, and all the crowd out here. So it's about 30% of rice. I think that is definitely a concerning point to all of us. Why that's happening? And some of these things that we discussed in the last 12 months is starting to happen. So sorry, I don't have a crystal ball, but two things I said I vividly remember is about the climatic change El Nino effect and also the protectionistic policy. I think I shared that in the second forum. I think we had all this forum, I think, in the last 20 months really. These two keywords, El Nino, climatic, and then also the protectionistic policy. If I can just go a little bit into this information. I look at this rise, it's sort of like moving up 30%. Okay, it is a price effect. So it's something we are mindful. It's not something that is getting so of a worry on a BAU. I think from a government aid policy and everything, I'm sure this price will be controlled. So don't freak out, everyone. All I'm saying is that it is definitely creeping up pretty fast. If you look at some of these things, El Nino, climatic change, that is creating some of this price impact. Why we say that? If you look at in India, for example, it is the number one trade flows for rice, I think about 40-50%. And they are basically having a bit of problem in the rice production because they are not having sufficient rain. You thought it's a monsoon problem. In fact, in some parts of the rice growing regions in India, they're having insufficient rain. India, the number two global exporter. Thailand is the number two global exporter. They are basically having also a drought, a rainfall problem. So what they are told, all this rice producer, instead of doing two production a year, they are asked by the association to only produce once a year. What it means on all these things is that the climatic change is a paradigm shift. Do we have a El Nino climatic problem 10, 20 years ago that's so difficult and drastic? No. That means price potentially can be a lot more elevated on the commodity level. So it's something for us to think through. And then the other point to share is about the protectionistic policy. I recall I shared about some of this protectionistic policy in some of the previous sharing and chat. This time around, it is happening in India. And what India has done in August, September, October is that they have started to basically impose 20% of this tax onto all their rice export. So that puts a lot of pressure on the supply. Prices are also higher. We are definitely very mindful, very concerned that all this so-called price pressure may potentially be drifting into, say, Thailand, Vietnam, and this will have a very different conversation for all of us about rice. Maybe we should start thinking of eating other kinds of carbo, I don't know, pastas, noodles, but some of these are also indirectly impacted by rice. But definitely something for us to think through on the mid to longer term. So yeah, rice is something to share, which I thought is a little bit of a signaling risk for all of us. And I'm having some chicken rice this weekend, and I'm going to share some of this talk with some of my close friends also about the rice price actions. So we're going to chat about it this weekend too.
I love it, Darren. Thank you for even just going into a topic that is so relatable to us. I mean, it's our everyday food here in Singapore. I mean, for those of you tuning in, I know we've got some of the favorite dishes coming in the chat. So thank you for participating in this. But as promised, now we're just going to go into the first quiz, and then I'm just going to show you how you can access the funds that we're talking about before we take the questions, okay? I've got a lot of questions coming in. I've chosen some already for Darren.
Oh, okay.
So we will be back with you, Darren, very, very shortly.
Thank you. Thank you.
So to everyone, type in yes. I see Dion K already type in a yes. Really, really on the ball here. Type in yes if you're ready for the first question of today. I hope you've been paying attention, everyone. And we're here in quiz 1. But for those of you who are new to this, remember that this is how the quiz works, okay? You got to get the question correct, of course. But then you've also got to be the fastest finger first, okay? So we'll reward the first 5 users for this. And you'll be awarded 500 points if you're tuning in app. So if you're ready, we are going to start with question 1, everyone, and go. What is the AUM of Fullerton SGD Cash Fund as of 3rd November 2023? What is the AUM of Fullerton SGD Cash Fund as of 3rd November 2023? Come on, fastest fingers first, everyone. We're getting so many different answers here. We're getting all kinds of answers in the chat. I see someone typing A and B. No, you have to answer one. One answer for each person. Is it A, B, C, or D? Okay, yeah, it's some of the very close answers here. I'm going to give you 5 more seconds for those who are still thinking. Okay, and congratulations to those who got the right answer. Now, Darren, what is the correct answer for this?
That's going to be 4.2 billion.
Exactly. It's 4.2 billion. The answer is C. Everyone, congratulations. Now, we will invite Darren back shortly because right now I want to show you how you can access whatever we just talked about very, very quickly. Again, I have to talk about the quick demo and amazing tools that you can access on the phone. So if you have your phone with you, if you're tuning in your phone, you can follow me right now. So if you go to your phone settings, you go to the app, right? So I've got the live on right now. You go to your watch list. Very, very simple. You can go right here to funds under the Discover tab. Okay, once again, Discover tab, go to Funds, and you can click right here, first icon on your left in bright orange, Cash Plus. Okay, so we've got 2 right now on here, and of course the Smart Save function, which you can read more of later on. But for today, we're going to go for Fullerton SGD Cash Fund, and over here you can see all the details of the fund. Okay, right now you can see we're live. You can also click on that and any news related to this fund. But essentially, it's about how you can track the performance of this and also the historical returns and position details. Now, this one is important because I track it myself. Go to position details, click on the arrow right here, and you can see everything that it entails right here, and it gets updated as well as we go along. And if there's anything new, it gets updated in real time. Okay, so you can see here the yields, and of course you can adjust according to time frame. Go to comments to see what people are saying about this fund, and also what the buzz is around this for related topics. Then you go to news right here to see what is the latest on this. Also related news, you know, everything is pretty much interlinked with everything else. But if you want to see something specific to this particular fund, then you go to announcements to see the latest announcements. Right now, there's no data for this, but if there's anything related that you must know, the teams will update it accordingly. Okay, go to analysis for more details on this, like the AUM that we highlighted, and summary for the overview if you need a macro perspective. So you can see right here, Darren Tay's name is right here for you guys to access. But you can have the fund documents as well, which is another question I get a lot from you guys. Okay, so you go to fact sheet right here. And you'll have the full details. Everything you need at your fingertips, and we've put it here to make it very easy for you guys to access. The heart here is for you to keep it on your watch list, so definitely give it a heart. And if you're ready, you can click on subscribe, which is down below on the bottom left-hand corner. It's so easy. So I hope that was very helpful for everyone. And of course, today's live, if you want to watch the replay, you can go to your live tab under Moo, and you can see right here, I'm tracking your comments, and I'm tracking all the support that we're getting for this. And of course, the questions that I'm going to ask Darren. Okay, so that's it for the tutorial. Anything else, drop it in the comments right now, or we'll leave an email at the end for you guys to really connect with the support team and the product teams for anything related to your app functions. Let's invite Darren back into the room. I'm going to remind everyone, we still got 2 quiz giveaways. Okay, so stay with me till the end of the show and you get a chance to win. Now, we got a lot of questions coming in. I've already picked the first question for Darren. So Darren, this user wants to know, you mentioned the bull and bear suit as well, and bear and bull suit. So if 2023 is a bull and bear suit, will we see 2024 as a bear and bull suit? Are there any recession risks that we need to be concerned about? And what is the analogy going into 2024?
Yeah, no, that is a great question. When I look at 2024, it's likely to be, it can still be 2 ways in my perspective. It can be a bull in a bear suit or a bear in a bull suit. I guess the more important strategy that we should deploy is that we probably will see a lot more of this so-called event risk that's happening. So, for example, banking turmoil, US debt, China situation, the Russian-Ukraine, or the so-called Middle Eastern. Let's ask ourselves this thing. Is it going to be like totally eradicated? I think the answer is no. If that is the narrative from a financial storm perspective, it's very likely that you will see markets sort of going whipsaw up and down. And I think that's where the narrative is going to be to begin. If you look at those perspectives, it means that, is it a bear? Not exactly. Is it a bull? Not exactly. Therefore, I'll just sharing on that one. So uncertainty is probably one key sharing, if I may put it, to begin. Going to the second point, to me, I think there's probably a little bit more of sentiments, kind of a rally, if there's any that's coming along. Back to the point about election year again. When it's election year, chances are things is going to be a lot more easy in terms of the financial market, not so harsh, not so tense. There's one slide and there's some information I thought was very interesting to share just over the line here. Globally and maybe in Poland, all right? Poland basically has started to cut its interest rate since July, August, and September. We call it monetary policy pivot. Why we use this word monetary policy pivot is because in the so-called Poland perspective, there was an election, in fact, last month in October. So what I'm trying to share is that if it's an election year, there's probably a little bit more easing that may potentially come because there's a lot more commitment, promises from all the different so-called parliamentary group that we want to make things happen. And I think they generally want to do that. And they want to give a lot of so-called better days, better life for all the masses and individual, or even for corporates. So I think there's this sentiments rally that may happen. But again, why I use the word monetary policy pivot in Poland is because they cut rates. So when you hear people talking about cutting rates, always go to the cross-sectional why they're cutting rates. And to me, that could be some of the reasons that's happening. Election came, therefore the rates are going down. And just last week or this week, early this week, Poland, the central banks, they came back and say that they are going to be hawkish again. They think at the way they go, they're not going to be able to tame the inflation. So they're going to go back to a bit of a hawkish truth again. So in short, I think on this point, what I'm just trying to share is that will tell us that if that means the narrative of the entire 2024, inflation will continue to be high and all these commodity prices will still be elevated. And that may not be as good from a so-called risk asset perspective. And sorry if I can just make the last point. Yeah, so that's about sentiments rally that may just come. I think the third point I probably can think of is if you look at the entire so-called dynamics of the market, yeah, we saw the financial storm will make you whipsaw. We saw the inflation situation. The third thing which I encourage everybody to think through is that we'll probably see a lot more opportunistic trading, a lot more positioning that goes right, that goes wrong. I think the way we position ourselves for 2024 is tend to be a bit more trending market, but definitely if we all believe in the Magnificent Seven at the S&P 500 to be sort of trending higher, that is definitely a drift that continue to be quite successful, and that could also be positive. So I think there are a few different moving parts, but all in, I would say it's a bit more rangy and whipsaw in some of these dynamics.
Thanks
Yeah.
for that. Now, the next question, I'm just going to put it into three parts here because we've got a mix of, a range of questions really referring to the same thing. So the first part of this, how can the different strengths in currencies for the SGD and USD going to affect the cash fund returns? That's one. And second, what is the difference between the liquidity fund or the cash fund? And the last part are the risks with the upgraded Fullerton cash fund.
The risk of the upgraded cash fund, which is a liquidity fund, right? Yeah. Okay. Yeah, maybe we should chat a bit about the FX to begin. I may have a slide on that. It's probably in the last few slides about some currencies. I don't know if the team can share on that as I start talking. In terms of the Sing Dollar Cash Fund and the Sing Dollar Liquidity Fund, thank you. Thanks for that. Thanks, team. This is a very interesting one. If we can just point everyone to the right-hand side, is about the currency consideration. But before I go into this item on the right-hand side, the SGD Cash Fund and the T0 Liquidity Fund, there are basically no currency risk. It's all purely Sing dollar. So you don't have a currency risk to begin. I thought that's an important point. And if for most of you out there, the investors, if you believe your base currency is Sing, you don't have any other currency risk to begin. I think that's what I want to share about the funds to begin. But let me just tackle on the right-hand side, which I thought is a very important part. If you look at currency, it does make a lot of difference in terms of our earnings, our returns, and what we get, or what we call total returns in our investment thesis. In 2022, SGD was very strong versus all the Asian currency pairs. And in 2023 year to date, it exhibited quite similar drift. As you can see from some of the screens at the bottom, the red color. Red color means that Sing dollar is probably very strong. In fact, it's very strong vis-a-vis all the rest of the Asian currencies out there. And I like to point to this point about Japanese yen. Of course, when we talk about Japanese yen, the first thing I know, Olivia, I'm not sure about you, but most people think about going to Japan for holidays. I've not gone. I'm
Yes,
planning. I
I
hope
know
I
three
can.
people around me already.
I have not.
Exactly.
My team has gone. I love to go soon. I'm looking at the air tickets. I'm trying to get some discount tickets out there. Just on that slide again, please. The Japan yen has weakened, I would say, more than 10% every single year, 2022 and also year to date 2023. So if you're a non-Japanese investors, and if you're buying the Japan Nikkei 225 ETFs and the likes of it, you are in fact losing quite a lot on the currencies. And what I mean by this is if you're a Japanese investors, you buy Nikkei 225, you'll probably be up about 20% in the last 2 years. But if you are a Singapore-based investors, and if you believe that your currency base is SGD, you translate that Nikkei 225 or the Japan equities into Sing dollar term, instead of having a 20% return upside, total return, you will in fact, I was looking at it just a couple of days ago and I was just thinking, wow, this is amazing. You will get in fact a negative 10%. So what it means that the currency risk is definitely a very important point. Is alpha capture is something that we should be mindful. And back to our point about the T0 liquidity fund. If you have a T0 liquidity fund, which is an SGD, you probably don't have to worry if there's going to be anything any problem to a US dollar currency or any other Asian currencies because your base is in Sing dollar, so you don't take those currency risks. So that's a very important point. And you only do the FX when you redeem your T0 liquidity fund and buy into US stocks, and then also buy into some of this Asian stock. Oh, by the way, before I forget, US markets, I'm sure you guys are experts also, is going T1 settlement cycle in May next year. Currently, I believe it's T2. So what it means is that the turnaround is going to be even faster. The more you need some of this T0 liquidity fund to manage your position. If I can just suggest, maybe you should hold some on a strategic basis on the T1 cash fund and also hold some for also your T0 liquidity fund. I think you use it for a different purpose. So it's an allocation within your cash strategies. So this is really innovative and I think it's very useful. If I can also share some thoughts, yeah, I think one of the related questions is what's the difference between cash fund and liquidity fund?
Yes.
Cash fund basically and liquidity fund, the settlement cycle is a bit differing. If you want faster turnaround, you get more into the T0. When I say faster turnaround, I mean same day T0 settlement. If you want something that's more strategic long term, you can probably buy into the cash fund. Say, it's a T1 from a design structure, but I know within the platform, you will take another 1 day or so to manage some of the ins and out. So it does vary in terms of settlement cycle. Maybe there's one difference. The second difference is that we probably would have, in terms of the allocation mix, I would expect the so-called T0 fund to have a bit more of the bills. Bills, because it's more liquid, you can transact into the secondary market. We'll probably keep some more cash for some of this liquidity purpose when there's a redemption on a T0 basis. So definitely the emphasis on T0 liquidity fund is very much predicated to the fact that we want to give end client liquidity, end client daily settlement. That's our key focus. Whereas for the T1 cash fund, less focus on that, but definitely we still have liquidity. So I think those are the key differences so in terms of its expectation. I think there's a question about risk. I guess in all funds, whether is it money market funds or any risk asset funds, risk asset, there are always inherent risks. If the drift or the exposure of the liquidity fund or the cash funds are very much allocated to, say, government bills in Singapore and also deposits, those are the potential risk consideration. And that risk element is very low, but allow me to share what are the risks. I think it's very important to share and understand the design of the structure, what are the inherent assets that we buy in. In terms of the exposure, as I was sharing earlier on, we buy into Singapore government bills. So if there's any risk, it's an exposure to the so-called Singapore sovereigns, because we buy into some of these MAS bills, T bills. So that is the exposure of the so-called product. But of course, we all understand that in terms of the government, Singapore's government's rating is definitely very much top on the list globally in terms of its sovereign's rating. The other risk, if I may look at it, whether it's a cash fund or the liquidity fund, we have what we call counterparty exposure. It's just that you go into any banks, you have a counterparty exposure. But the key important point is that when we look at some of this design of fund, we only buy into very investment grade counterparties. So what I mean by investment grade counterparties? So in terms of the ratings, they have to be, say, for example, under the Fitch rating, it has to be F2, F1 or F1 plus or better. So it means it's very highly so-called investment grade driven. And we use this rating just now is because they are considered short-term rating and is prescribed by the Code of CIS under the local regime. If you look at it from a long-term rating, it means A minus on a long-term definition. So it's definitely, on a very safe side in terms of this perspective. So I think these are some of the key thoughts I can think of in terms of the risk. And maybe I should also share what's the beauty of some of this fund, or maybe I should say what are the assurance from some of these products. We definitely don't buy into so-called any corporate credits. Corporate credits succumb to volatility. We do not want to buy into corporate credits. That is a for sure for any of these products that we launch on the cash fund or the liquidity fund. We do not have any of this FX risk. We never want to engage in any foreign transaction or asset. We do not want to basically have any leverage. We definitely don't think the leverage is something that we want to have. So we're not going to amplify, expose to futures, margin. That's not what we want. We want to make it really simple, understandable, and we want it to be very as safe as we can. So I think those are very key important point of what is inherent within the funds itself. So I hope that's useful on those, Olivia.
Very, very useful, because those were the three-part questions that we're getting a lot of. So thank you for summarizing those points and also for the comprehensive answer related to that. Now, I know everyone's ready for quiz 2, so I'm going to interject here for quiz 2. Now, Darren, be ready to answer the question as well. But we've got very, very enthusiastic people in the chat box. I've been monitoring it. So thank you so much for your energy right now. So quiz 2, let's show the question and go. Which event, risks, and financial storms were mentioned in the presentation? A, U.S. banking turmoil, B, U.S. debt ceiling, C, China debt markets, or D, all of the above? Let's go. Let's go. Fastest fingers first.
All right, go.
Okay, people are really fast. What is the correct answer, Darren?
It is D, all of the above.
Exactly. It's everything. So congratulations to everyone. Send in your hearts if you think you got the answer correct. So thank you for that. Okay, so let's go into our last question before I go into the final quiz, and then we'll round up our discussions because we have a part 2 of shows for you today. So everything is crafted and created just for you. So please be there for the second show as well. And so far right now with Darren, he's very popular with a lot of questions coming in. But Darren, let's go back into the macro outlook, okay, as a final question. So we've got 2 parts to this. Now, you mentioned China, right? So you're talking about the big Chinese stocks that are relatively cheap now. So what do you suggest, or at least what are your insights for new investors trying to get into this space, whether they should hold back, any sharings for this? And second part would be the Southeast Asian industries and also rising stars upcoming for 2024.
In terms of China, clearly the data points has been very weak to begin. Even on the month-on-month, the so-called inflation has been on a negative drift. So these are definitely key concerns. So economic data has been a little bit on the weaker side. Coupling with that, I think the pressure on the so-called property sectors has been quite a challenge. And what I mean by this is that you do have some of the corporate challenges out there that's going through, like Evergrande and some of these names. At the same time, you also notice that in terms of the so-called local government, so-called expectation of how some of these debts are being panned out, I think those are clearly challenges. But I think the key sharing is that the governments of China is definitely making a lot of efforts to make it happen, to stabilize the problem. I think those are really things that they are trying to do as much as they can. Back to my earlier sharing, they're going all the way out to the US, to woo the investors, woo the corporate, woo the so-called administration of Biden. My view is that as much as negative, there has to be somehow a bright spot eventually. It's a timing difference, and it's something for us to think through. But as a whole, I understand it's currently negative as a view for most people, but it's something for us to look at sort of turning points or the signaling risk that turns out to be a lot lesser, and then we can just go from there. So that's probably about China. If we're talking about the neighboring countries and in the region, I always thought that the tech companies, Korea, Taiwan, those are great. I think they've done very well. I'm just guessing maybe because of Taiwan. If for those who are looking at the Asian market, you probably notice that Taiwan has been one of the best performer in the region in terms of its equity markets. Why is that the case? Well, you can say it's a reason of some of the key stocks out there like TSMC, AI-driven, semiconductor-driven, but also election is coming along in those timing. So that's also the drift why I think some of these are the bright spots. And also, if you look at the whole scheme in Asia, ASEAN countries, I think they've been doing quite well. They've been managing their risk, they're controlling their inflation, They are controlling their interest rate policies. Demographic structure continue to be very strong. I think those are things that definitely would have been positive. So I think all in, I would say that the Asian economies, the ASEAN economies, is something to look out for. And if the dollar ever sort of weakens, that means as a whole, Asian economies can do better, because if dollar is strong, that means Asian economy tend to be a little bit on the weaker side. But now you can see all the Asian currencies are starting to be getting stronger in the last couple of weeks. So there's something to watch out for in terms of the signpost, when we put it this way.
Mm-hmm. Thanks for that, Darren. And with that, before we go into the final takeaways, quiz 3 for everyone. Type in yes if you're ready.
Yeah.
Are you ready for quiz 3? Yes, very ready. Okay, perfect. And the question is, let's go. What are the key features of Fullerton SGD Liquidity Fund? A, same-day liquidity. B, possible alternative to a savings bank account. C, enjoy competitive yield compared to traditional bank account savings rate. Or D, all of the above. And if you're done with your answer, if you think you got it right, give me a big heart or a thumbs up, everyone. Yeah, everyone is very fast. We've got someone here who's saying, this is all dependent on my Wi-Fi connection. So what is the correct answer, Darren?
Answer is D, all of the above.
Exactly. Congratulations to everyone who got that right. Our teams will be in contact with you if you are the winner for this. Now, Darren, with that, what are your final statements for our audience tuning in today? They've got such great questions, and thank you everyone for being here.
Well, thanks for joining the audience out there. I know it was great fun, and I got very excited. You know me well enough. I think we've been talking on the line for quite a while already. If I look at 2023, it's definitely very challenging. Sometimes I ask myself, if in US we just buy and hold for the whole year, we will make 20%, but we continue to trade along the way to look for opportunity. It was very volatile. It was very rough in the last 11 months. We hope things can be better. But heading into 2024, I believe the market will still be choppy. We can be opportunistic, bear in the bull suit, bull in the bear suit. It's all right. Either way, we have a way to manage it. Plan it well. Use the T0 liquidity fund and the T1 cash fund well. Plan your trade to the plan. We all will make it and we'll all be successful. So that's my parting words, if I may, Olivia.
Really powerful statement there. And that was Darren Tay, everyone, Head of Treasury Management from Fullerton Fund Management. Thank you, Darren, once again. And we'll see you next year for our upcoming shows.
Thank you, Olivia. Thanks, everyone.
Thank you.
Great having me.
And once again, to the audience, really, thank you for being here with us. We've got the next show upcoming. I'll share some details later on, but do connect and follow us, okay? If you really like content like this, you can scan the QR code here, or if you're in the app, type in moo_rich to follow more funds content and insights related to fund themes. If you have any thoughts, you can join the event here and type in your thoughts in that last screenshot. So we really want to hear your thoughts. It's about community here. So I'm really happy that you guys have submitted your thoughts in the chat box. I will be reviewing it after the show. And next up, if you want to stay connected with me, and if you want to really type into me what you want to see next, topics, speakers, anything you like, type it into me right here by scanning the QR code. And of course, follow our socials. We are very active on YouTube, Instagram, Telegram, TikTok, everywhere. Do follow us on there and show your support, and also be really at the forefront of everything that comes up in terms of content, okay? And of course, contact us right here. Here's the email that we promised to everyone. Here's our client service email. So do drop us a message here if you want to collaborate, or if you do want to ask any inquiries related to products especially the funds today that we covered, and also the upgrades. If you need more details on that, do drop us an email, okay? And with that, we'll see you for the next show, everyone. That's happening at 5 p.m. So be sure to tune in, because here we are on the final day, the final show for you guys. So really, we're going to cover, are we truly at a turning point right here with another speaker? So definitely check it out and check out the replay from today. We'll see you later on. Have a great time. And yeah, in about 40 minutes, we'll see you here on the live show. Once again, you're with me, Olivia Higgins.